Right now, something is happening in the precious metals market that almost nobody is talking about. And it could quietly destroy unprepared portfolios while creating massive opportunity for those who understand it. The gold-to-silver ratio, a number that most investors ignore, is beginning to shift. And when this ratio collapses, wealth doesn't just move, it transfers. Throughout history, these moments have separated the informed from the blindsided. And the difference often comes down to one simple decision made at the right time. If you want to protect your financial future and understand what could be coming next, make sure you like this video and subscribe to the Gray Ledger. Because this channel exists to help you see the financial shifts before they become headlines. Most people think gold and silver move together like two partners walking in the same direction. But the truth is, they move at different speeds, and that difference creates opportunity. The gold-to-silver ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold, and this number tells a powerful story about relative value. For example, if the ratio is 80, it means it takes 80 ounces of silver to equal the value of 1 ounce of gold. But this number doesn't stay still. It rises and falls, sometimes slowly and sometimes violently. When the ratio rises, it means gold is outperforming silver, and silver is becoming cheaper compared to gold. But when the ratio falls, it means silver is gaining strength faster than gold. I think that's where things start to get very interesting. Because historically, silver doesn't just move a little faster, it often moves dramatically faster. In past cycles, when the ratio collapsed, silver didn't just climb, it surged, shocking investors who weren't paying attention. This happens because silver lives in two worlds at the same time. It is both a precious metal and an industrial metal, which means it responds not only to fear, but also to economic demand. Gold is mostly driven by wealth protection and central bank behavior, but silver is driven by both protection and production. And when those forces align, silver can accelerate in ways that gold simply cannot. Right now, many investors hold gold because it feels safer and more stable, and that instinct makes sense. Gold has always been seen as money, as security, as something permanent. But silver has something different, something explosive hidden beneath its quiet surface. When the ratio begins to fall after reaching extreme levels, it often signals that silver is about to enter a period of outperformance. This doesn't mean gold is weak, it means silver is waking up. And when silver wakes up, the move can be fast, emotional, and powerful. Most people don't notice it at first, because early shifts in the ratio are subtle and easy to ignore. But by the time the average investor realizes what's happening, the biggest gains are often already behind them.
To understand why this ratio matters so much, you have to step back and see how markets actually rebalance when something stays out of alignment for too long. Extreme ratios rarely last forever because they represent imbalance. And markets have a natural tendency to correct imbalance over time. When gold becomes too expensive compared to silver, investors begin looking for value, and silver starts attracting attention. At first, the shift is slow and quiet, almost invisible to the public. Institutional money begins to move, not loudly, but deliberately. Large investors don't chase headlines, they position before the headlines appear. They understand that when silver is historically cheap compared to gold, the probability begins to favor silver. This is not about guessing, it's about recognizing patterns that have repeated over generations. There have been periods when the ratio climbed above 80, even above 100, and each time, eventually, it reversed. And when it reversed, silver didn't just match gold, it often outpaced it by multiples. This is because silver is a smaller market, and smaller markets move faster when new money enters. It takes less capital to push silver higher compared to gold. And when momentum builds, it feeds on itself. More investors notice the price rising, and they rush in, accelerating the move. This is how explosive phases begin, not with panic, but with quiet repositioning. Another force behind silver is its industrial importance, which many investors underestimate. Silver is used in solar panels, electronics, medical devices, and emerging technologies. This means silver is not only a store of value, it is also a material of necessity. As the world becomes more electrified and more dependent on advanced technology, silver demand grows. This creates a foundation beneath the price that didn't exist to the same degree decades ago. At the same time, silver supply does not increase easily or quickly. Most silver is mined as a byproduct of other metals. which means production depends on the economics of those metals, not silver alone. This creates constraints that can tighten supply unexpectedly. When rising demand meets limited supply, price pressure builds. And when that pressure releases, the moves can surprise almost everyone. The ratio reflects this tension between gold's stability and silver's potential energy. When the ratio begins to fall, it signals that energy is being released. It signals that silver is beginning to close the gap. This is why experienced investors watch the ratio closely, not as a prediction, but as a signal. A signal that the balance of power may be shifting. A signal that the market may be entering a different phase. And phases are where fortunes are quietly made and quietly lost. Because by the time the shift becomes obvious, the easy opportunity is already gone.
So the question becomes, how do you protect yourself? And how do you position yourself before the ratio makes a larger move? The first step is understanding that this is not about choosing gold or silver as enemies, but about understanding their relationship. Both metals have a role, but their roles change depending on timing and valuation. When the ratio is extremely high, it often means silver is undervalued compared to gold. This creates a window where reallocating even a small portion of holdings can increase long-term potential. Some investors gradually shift part of their gold into silver during these periods, increasing the number of ounces they hold. They are not increasing their risk blindly. They are increasing their exposure to the metal with more upside potential. This strategy is not about emotion, it is about mathematics. If the ratio falls, the relative value of those silver ounces increases faster. Later, some investors reverse the process, shifting back into gold after the ratio drops significantly. This is how some investors slowly accumulate more total metal over time without adding new money. They are using the ratio itself as a tool. Others choose a simpler approach, holding both metals but increasing their silver allocation when the ratio reaches extreme levels. This creates balance, while still allowing them to benefit from silver's stronger phases. Another important principle is avoiding the mistake of chasing sudden spikes. When silver is already surging and excitement is everywhere, the easy phase is often ending. The better opportunities usually exist when silver feels ignored and boring. This requires patience, and patience is difficult when markets feel uncertain. But the ratio helps remove some of that uncertainty by providing perspective. It shows when silver is historically cheap and when it is historically expensive. This transforms investing from guessing into observing. It turns emotion into awareness. Some investors also use physical silver as a form of financial insurance. Not because they expect disaster tomorrow, but because they understand uncertainty is part of the system. Physical metal carries no counterparty risk. It does not depend on promises, contracts, or digital systems. It simply exists, quietly holding value across time. Others use silver exposure through financial instruments, allowing flexibility and easier rebalancing. The exact method matters less than the principle behind it. The principle is positioning before the crowd arrives, because once the crowd arrives, the advantage begins to disappear. And the ratio, quietly moving in the background, often gives the earliest clues. This is ultimately about preparation, not prediction, because no one can control when the ratio will move, but you can control how ready you are when it does. Markets reward those who prepare during quiet periods, not those who react during loud ones. When the gold to silver ratio begins collapsing, it often happens during times when financial stress is already building beneath the surface. Gold usually moves first, because it is the traditional safe haven. But silver follows, and when it follows, it often moves with greater intensity. This is where portfolios can change dramatically, either positively or negatively depending on positioning. Investors who ignored silver may find themselves underexposed to one of the fastest moving assets in that phase. While investors who prepared may find their holdings gaining strength faster than expected. This is why balance matters more than perfection. You do not need to guess the exact top or the exact bottom to benefit from the shift. You simply need exposure before the crowd fully arrives. This reduces the emotional pressure of trying to time everything perfectly. It also creates peace of mind, knowing you are not dependent on a single moment. Diversification across both gold and silver creates flexibility, because regardless of which metal leads, you remain aligned with the overall movement. Another overlooked benefit is psychological strength. When you understand the ratio, you stop reacting emotionally to every price swing. You begin to see the larger pattern, and that clarity creates confidence. Confidence allows patience, and patience allows better decisions. This is how experienced investors stay calm while others panic. They are not smarter, they are simply more prepared. And preparation turns uncertainty into opportunity. Right now, the ratio still tells a story that most people are not listening to, but eventually, everyone will hear it. By then, the repositioning will already be well underway, because your insight could help someone else see what they were missing. And share this video with someone who still believes gold and silver always move the same. Because that single realization can change how they see their entire portfolio forever.